Welcome to the Mountain Path, the world of finance. This is Professor Ravichandran from Bangalore. This session will discuss valuation and scenario analysis as part of financial risk management course. So we'll cover from chapter 7. The reference book is Financial Risk Management of Financial Institution by John C. Hull. So what are the pre-requirements for this session? Black-Scholes option pricing model basics. So what are the learning objectives? The learning objectives we'll cover valuation scenario analysis techniques using theoretical probability calculations, real-time market data analysis, and scenario modeling. So what are the core important methodology is a geometric Brownian Mason framework. So we use the standard assumptions that we use in our Black-Scholes option pricing model. The stock price follows a log normal distribution with a constant drift and a constant volatility, and prices of the assets are log normal distributed. So we can assume this and we can calculate the probability of a price at time t exceeding a target value with a given time. So that is nothing but normal distribution of D2. And similarly, the probability of a stock price at time t going below the targeted value is normal distribution of minus D2. So we'll quickly go into an example here. So let's assume the stock price is 100 with a drift of 15% continuously compounded with a standard deviation of 20%. And what is the probability that will be greater than rupees 120 in 6 months with the current price 100? What is the stock price that has 10% probability of being exceeded in 6 months? So we'll quickly go into the data, given data, current stock price 100. The drift is 15% continuously compounded and the standard deviation is 50% with a time of 6 months, that is 6 by 12, and we have a target value of 120. So the question is, so what is the probability at the stock price at time t will exceed 120? That's the question. So we use and the same Black-Scholes option pricing model formula. D2 we calculate. In D2 we calculate ln of s divided by the strike price plus risk-free rate plus half the variance into time and divided by sigma into square root of time. Now we make two important changes in the Black-Scholes option pricing model D2. First, instead of strike price K, we use target value B. Instead of risk-free rate, we use the drift, the returns. That's the two changes we do in the calculations. So let's quickly go into and split the D2 formula into two. Just a numerator of D2, there is nothing but the current stock price divided by the value, target value, and plus half the way, plus the drift minus 0.5 into the standard deviation square and multiplied by time. So that's a numerator. So what is the denominator? Sigma into the square root of time. So we got the numerator and the denominator, and we got the D2 now. So now straight away take the norms list of D2. That will give you the norms list of D2. That will give you the probability. The stock price exceeding 120 at time t is 120.34. Now we can also calculate what is the stock price that goes below probability of ST below the distance. Is simply that the same thing, and instead of calculating norms list of D2, we'll calculate norms list of minus D2. That's it. So we just need to modify only norms list of D2 for the value that is exceeding the value and ST going above 120. Now probability of going ST going below 120 is a norms list of minus D2. That's it. We can also do an analysis and by actually and do various and analysis of volatility. I've just taken volatility here. I've just taken different time frame here. So what should be the different probability? So I use what is called simple data table analysis. So just link this calculation here, and then for various time frame versus volatility, we can estimate what is the probability. So go to data, what if analysis, and take the data table. On the row input, I have taken volatility here. So the volatility is 20%. And the column input, I have taken the time here. And so that means we can estimate, we can do analysis. As you can see, as the volatility increases to 30, 40, and for that same 0.5, it increases. What is called the probability increases here. Similarly, and we can also for the any volatility, let's say 20%, we can see as the time frame increases, the probability increases. You can do an analysis. Now, the next part of the question is what is the stock price that has 10% probability being exceeded in 6 months? So, we need to calculate the value. What is the stock price that has a 10% probability? You can so that means given the 10%, rest of the inputs remain the same. So the formula is actually and the probability of ST greater than V and is equal to Q. That is, we want the value V. That is nothing but current stock price and exponential mu minus half the variance in time minus norms inverse the probability into sigma into square root of time. So there is nothing but first calculate the part of the formula. That means mu and minus zero point 0.5 into a 0.5, zero point 0.5 variance. That is this one to the square and put it in bracket multiplied by time. So multiplied by and time. So that will give you a part of the formula. And then the next is a norms inverse of. So norms inverse of okay, normal standard inverse of the probability, that is 10%, multiplied by sigma and multiplied by square root of the time. So that is the formula. And so we got this one. Now you calculate current stock price and into exponential of this one, current stock price into exponential of this minus this one. So we get 127. So, and with a given probability of 10%, this goes and the value that will be exceeded is 127. So we can also do an analysis with the different So this is a probability here, and I've taken different probabilities from 1% and as well as using then taken different time here. So I've taken what are all the values. Let's say the same thing. That there is a probability of 10%, and that means with a time frame of 0.5, you can see that time frame 10 and 10%. So you can see that, and this is 0.5, right? And the probability is 10%. So, so we can calculate. Let's see that. This is 127. This is correct. So exponential and the formula is minus this one. Both the calculations are correct. Fine. Exponential minus. This one norms inverse of standard deviation to square root of time. That's fine. So this one is mu and return minus half the variance into time. That's formula. Got this one. That's correct. So all the check calculations is correct. Now we link this. So this one, let's delete this and do it. Now this one is a probability. Now this is a data table. So the numerator cell is a probability. So this is a probability. And the denominator is a time. We got this. Now I got the calculation correct now. So we can check 10%. This is fine. Now the next is I've taken live data of a ITC stock. Current price is 409.95. I've taken log normal returns for the 5 years data. I use a real-time data and I multiply it by 252 annual returns. Now I've taken standard deviation, daily standard deviation into square root of 252. Now using the live actual data, so I calculated D2 and the target value of 450. So in next 9 months, what is the probability of ITC going above 450? And he is a 16 point, and that is 56.5%. Similarly, the current price 409.95, and with a given probability of 50%. So what is the value that will be exceeded? The value will be exceeded, and in the next 9 months is 463.5. So we can use real-time data. I've used one more State Bank of India also done the same thing. So what are the key important learnings from here? So we are able to calculate the probability-based scenarios for any value v and time t, and we determine the probability using n of d2. Similarly, for various value at risk scenarios for given confidence level 95%, 90%, whatever it is, we can calculate the corresponding asset prices. We have done also the stress testing using for various high volatility, and so we can do changes here. And the key risk management insight is what is the impact on volatility, time decay, what is the expected return consideration, and what is the model consideration. There are practical applications for portfolio risk management, option pricing validation, capital allocation decisions, and regulatory compliance. So thank you very much for watching. Hope you all learned something on valuation and analysis this time. Thank you.